Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and I'm finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist. And we are
the Money
Café, Alan. Great to see you again.
Good to see you, Stephen. Now, latest news, this morning's news, is that the Court of International Trade has blocked Donald Trump's tariffs, which is, I think, really interesting. So the Court of International, even though it's called an international court or the Court of International Trade, it's actually an American court peopled by or staffed by American judges. They're all in Manhattan, basically. And a few of them were appointed by Trump in his first term, a lot of them by Obama. I mean, and they've basically come out last night and said that Trump has exceeded his authority in imposing all the tariffs.
And only Congress can approve it, according to the Constitution, which we always sort of knew that, didn't we?
Well, he was using the
emergencies,
International Economic Emergency Powers Act to usurp the congressional power over trade, which theoretically allows him to do. But the Court of International Trade has said that, in fact, the trade deficit, which Trump cited as being the emergency, is not an emergency at all, which yours truly has written a few times.
You have.
Crikey,
you've been calling fake emergency for a while, haven't you?
I have, and I said and I thought that if that's an emergency, anything's an emergency, and look out because there's plenty more things he can do with emergency powers if he's prepared to declare anything an emergency.
We're going to need a new acronym. I loved the question at his press conference this morning from CNBC's reporter Megan Casella, who asked about the TACO trade, which stands for Trump Always Chickens Out.
Did she ask? Did he get asked about that? I didn't see that.
Yeah, and he was really angry. He ranted on, and then he goes, "That's a nasty question. That's a ridiculous question." So he was really, really angry. And actually, with his psychology, the worry is now that having been told there's an acronym, TACO, does he then try and go all tough and He-Man just to prove that TACO critics wrong? But I think maybe it's not a case now with the court. It's not just that Trump always chickens out, is that maybe the courts will also stop him from doing crazy tariffs.
I talked about the TACO trade on the ABC News last night and said and attributed the rise in the markets and the rise in the US dollar to the TACO trade, and noted that maybe if the acronym turns into TGIF, the markets will go down, which stands for Trump goes in fully. It was a bit of a made-up acronym, but you know what I mean. Like, you're right. If Trump now thinks that everyone's laughing at him because he chickens out all the time, he'll do the opposite and start bloody going all the way.
But he does want prosperous markets, you would think. So hopefully, it is a case of more bark than bite. And I guess NVIDIA today is another example of that. I mean, the ban on the H20 export into China is going to cost them $8 billion in revenue in the July quarter alone. So they're only going to have $45 billion US in revenue, and it would have been $53 billion US in revenue if they received the $8 billion US dollars in revenue in 90 days from China. But in spite of that, losing that $8 billion, NVIDIA shares are up almost 5% in the aftermarket. The revenues are incredible. And NVIDIA, which is probably, very, very heavily exposed to these tariff wars, is still, approaching record highs, has bounced 40% in the share price terms since the lows of April 4. So it's huge and it's prospering, even though billions and billions are being hit off their revenue line by Trump's interventions with this war on China.
And I think the other thing that's this last night's court case loss tells us about what's going on is that it may not be the bond vigilantes who rein Trump in. The assumption has always been that, if he goes berserk and does too many wrong things, then the bond market will go, the bond rate will go up, and that'll kind of cause him problems, as it did with Liz Truss in 2022 in the UK. But actually, what's more likely to prove a problem for him is the courts. I mean, there are 250 lawsuits now before the courts that are attempting to thwart all the various Trump administration actions. And there's a website you can use to track them all. Just Google court cases, lawsuits against Donald Trump, and you'll find it. And according to a political scientist named Adam Bonica, Trump and the administration have suffered a 96% loss rate in the federal courts in May, and the losses were non-partisan. 72% of Republican-appointed judges and 80% of Democratic-appointed judges ruled against Trump. So he's really up against it in the courts, and everyone's suing him.
So the rule of law, the guardrails of the rule of law will hold. That's the thesis. Plus he'll chicken out.
So it depends. It'll depend a bit, and I think this will be a really important and interesting development as to whether Trump actually obeys the courts. I mean, what happens now with the Court of International Trade thing on the tariffs? I mean, he's appealed immediately, so the tariffs stand until the appeal's heard. But what happens if he loses the appeal?
Oh, look, I think it's hard work ignoring court decisions in the US. I mean, I agree. People say, ultimately it comes down to, guns. If you don't follow court orders, because you'll have contempt findings and people will get thrown in prison for contempt. So, yeah, I agree that he'll try it. I mean, he'll try anything. We've seen with the massive corruption where he's still selling pardons to crooks and, making bank on his meme coins and all the sort of rubbish that he's doing.
Pardoning power is really important and powerful. He can pardon anybody.
He's monetising it. It's a stupid power. It should be taken away. I mean, Albo can't start, pardoning Ivan Milat or, whatever we could do here. So it's a crazy power, and he's monetising it like he monetises everything. He embraces Bitcoin and crypto, and then he's made hundreds of millions selling his own meme coins. And Vance was in Las Vegas this morning addressing 35,000 people at the big Bitcoin conference in Las Vegas, talking up how they see crypto as a, quote, a force multiplier of our economic might. I thought that was a great quote from Vance this morning. But
35,000
people attending the big crypto conference in Las Vegas. I mean, the crypto industry literally got hundreds of people into the Congress. They spent, I don't know if it was billions, but they spent hundreds of millions on campaign finance getting their people up. And they didn't think Trump was going to go and cut their lunch and monetize his own meme coins the way he's done. But, and I still don't understand why you'd back up crypto when it undermines the US dollar, which is the global reserve currency, which ultimately is the number one thing that protects the fact that you've borrowed $37 trillion off the world and you're running a deficit at 7% of GDP. So it's going to be 40 trillion by the end of his term, the way he's going with borrowing with his ears pinned back, with massive budget deficits as the budget they're trying to get through at the moment with the huge tax cuts.
By the way, we probably just on the subject of monetising the pardons. What you're talking about is a fellow called Paul Walshak, who was a former nursing home executive who pleaded guilty to tax crimes in 2024, and he went to jail, and he got 18 months in prison and $4.4 million of restitution ordered by the court. His mother paid $1 million to go to a dinner at Mar-a-Lago, and the following day he was pardoned by Trump. I mean, it's unbelievable.
We had a bloke, a New South Wales prisons minister called Rex Jackson, who was done for corruption for giving early release in exchange for backhanders, and I think he finished up selling hot dogs. I think the last time I caught up with him, that was his career after being drummed out of politics for that sort of corrupt regime. So, look, it is the fact that the law doesn't intervene with how much Trump is personally monetising the most powerful office in the land. I think that's the thing that is the most shocking. But the markets obviously don't deal with that because that's just what's a few $100 million of personal profits for Trump in the context of tariffs and all the other crazy stuff going on.
On another matter, what do you think of the crash of Healthscope?
Look, it is. I was thinking in terms of the biggest collapses in Australia, from HIH and OneTel and I guess Virgin, the PBL Media, Pasminco, it's right up there because of its 37 hospitals across the country. I mean, it's got every state government sitting up, panicking from Tasmania to the Northern Territory. Healthscope has hospitals all over the country, and people are really nervous. And what I find amazing, Alvin, is the way that there's 5 Chinese government-owned banks that have bought up more than $300 million of the debt. And all the Aussie big 4 banks, a lot of them are just selling out and running away. So they collectively owe less than $200 million, although Commonwealth Bank's talking about offering $100 million for operations. And then you get these London and US hedge funds coming in and buying up the debt. And so you have this big sort of opaque dance of the owners of the $1.6 billion in debt will now decide what happens to our second biggest private hospital company. And the big 4 banks sort of, nowhere to be seen, and government's nervous, and private equity, in this case, Brookfield, lost $1.7 billion. It's one of the biggest private equity disasters.
I know, that's incredible,
in Australia.
That's incredible. But do you know how many cents in the dollar the buyers of the debt paid?
Oh, well, some of it's been as low as 40 cents in the dollar. So I don't understand why our big banks just run away and take losses. I mean, I would have thought that these 37 hospitals are definitely worth more than $1.6 billion. So you'd hang on to all your debt and demand 100 cents in the dollar. I mean, why should the shareholders of ANZ, which scurried out the exits 2 weekends ago, accept 60 cents or 80 cents or whatever it is, but it's a discount. It's a discount to 100 cents in the dollar when they should just stick it out, do the hard yards, deal with the assets, and get 100 cents in the dollar back. But they just run away from a fight, don't want the brand damage of, this bank was involved in the potential closure of maternity wards in Darwin. They run away from the publicity, and it gets left to these sort of faceless hedge funds. And now we discover 5 government-owned Chinese banks which have bought up the debt as a sort of a leverage play. But, who will end up owning these 37 hospitals? Because Ramsay can't buy them because they're already the biggest player. We've got a bit of a duopoly with private hospitals. Will the state governments buy some? Will the Catholic Church buy some through St Vincent's? Because they don't pay any payroll tax, so they've got a massive competitive advantage in terms of the operation.
I think the health insurance funds ought to buy them.
Well, this goes to your story recently about, is it Adveni, the new hospital in Kew?
Adney Private Hospital, half owned by Medibank Private. Yeah, so I think that do that. The health fund should own the hospitals.
Well, that's the model globally. So, and there's no real regulatory reason unless APRA starts to come in and say, hang on a minute, regulated insurers can't take big risks owning bricks and mortar hospitals. So you may get a regulatory issue, but I agree, it is logical. That's what happens in the US and many other markets, that the health insurers also own hospitals. But I don't know, when you get that sort of vertical integration, I mean, we saw that in the power industry when, the generators started getting into retail and AGL and Origin became all-powerful gen tailors. I don't know, do you really want big conglomerate insurers and hospital companies in Australia?
Yeah, I don't know. At least they won't go broke.
Well, that's true. That's true. So, but look, whoever finishes up with those 37 hospitals, I just hope we don't see Ramsay being allowed to buy too much, because we're going to get more and more duopolies in Australia.
I presume the local banks are trying to get their money back so they can lend it on housing, because they're making so much money out of housing.
As Don Argus said, they're just giant building societies and they don't worry about financing business.
I've just this morning been reading the latest annual report from Demographia, which is the California-based think tank that produced an annual report on housing affordability around the world. It's a sort of a global look at housing affordability. And Sydney is about to take over as the most unaffordable, least affordable, most expensive housing market in the world, taking over from Hong Kong. Sydney's house price to income ratio, according to this Demographia report, is 13.8 times. Hong Kong is 14.4 times, but its house prices are falling and Sydney's are rising. So Sydney will probably take over as the most expensive housing market in the world in the next 12 months. And Australia overall is the second least affordable market at 9.7 times income, median income to median house price ratio, which puts Australia as a whole into what Demographia calls impossibly unaffordable. So they have various categories ranging from affordable to impossibly unaffordable, which applies to anything over 9 times income to house price ratio. And Australia is impossibly unaffordable.
Also, to put the opposite spin on it, the world's richest and most attractive country. I mean, I agree there's lots of supply issues and policy issues, but it is also a function of Australia's relative place in the world that, we've got a question later about this, but people don't leave. Everyone wants to come here. Everyone wants to live here. Lifestyle, massive redistribution policies with the government, stable democracy. Who wouldn't want to come here? And that drives up housing.
Your glass is half full, Stephen.
I agree. I'm not defending it, Alan. I'm just saying that it is a function of prosperity and popularity in the global sense to a degree. But we need to get on with building stacks more housing stock, and many countries are, the UK, promising hundreds of thousands, not even getting half of what they're promised. It is quite difficult all over the world to build new housing supply at scale in an affordable way. Okay,
we better move to questions. Unless you want to talk about AGMs, do you?
Oh, look, I was just going to briefly say that we've got 18. We had 18 AGMs yesterday. There's 43 today. So it's the biggest day of the mini season, which finishes on Friday, and there's 38 on Friday.
And how many have you lobbed questions into?
Oh, I'm up to about 65 for the year. But I just crunched the numbers. So there was 89 meetings in April, 51 in January, 81 in February, 52 in March, 272 in May. So all the December 31 companies, they leave it to the last minute. So this week, with over 100 meetings this week alone, it is very, very busy if you're trying to be a shareholder activist. But to put that in context, there was 212 in one day on November 29 last year. So, 70% of companies are June 30. The busiest time is November, but right now this week, it is pretty crazy busy. So I'm trying to get to. Yesterday I had Life 360, Drone Shield, Eagers, Fluence, all these things at the same time. Ended up only getting to 2 of them, but and the fact I thought was most interesting at the Eagers Automotive AGM yesterday was the CEO, whose stock's now worth, 25 million, Keith Thornton, because the thing is absolutely booming, was saying that the Australian auto market is the most competitive in the world because you've got no tariffs here. You've got 70 global brands all scrambling to get into Australia, with the 1.2 million car sales a year, and that they've got 14% market share now, up from 10% before COVID. And he reckons that's the biggest market share of any car retailer in any Western market in the world. So it's those car dealerships, it's very fragmented. But this company is now worth $4.6 billion, Eagers Automotive. And they've got this amazing dealership in the Indooroopilly shopping centre, which is in Brisbane, owned by Dexus and the Commonwealth Government. And they've got 75 staff there. They get 1,500 visitors a day looking at the 250 cars. So is this the future of car retailing? Is that they go into shopping centres? Because he couldn't talk up enough how this Indooroopilly shopping centre car dealership that they've got is absolutely booming. And he thinks
so where
that's
is
the
it?
future
Where is it?
Inside the shopping centre.
Inside? What do you mean?
Yeah. Yes, it's attached to the shopping centre. So they've done a deal with Dexus and they've built this massive 250 car dealership as part of the Indooroopilly shopping centre. And he says that people, they love going to the shopping centre, so they're all pop in, look at a car. Next thing you know, they're buying it. So the staff, 75 staff, are doing 2 million. I think it was a year, 2 million in sales a year versus the average is only 1.2 million per staff member in your normal dealership. So
that's incredible.
Watch out. Westfield could do a deal, and we could get cars all over shopping centres all over Australia.
Well, sounds like it works. They're obviously going to keep doing it, are they?
Yeah. Well, he was talking it up a lot. So, and the other funny thing was that I asked about, there was a 10% protest vote against the remuneration report and the CEO's incentive grant. Did one of the proxy advisors recommend against? And the chairman, Tim Crommelin, said, yes, ISS, their report was rubbish, misleading, full of errors. I've never seen a chair froth. And I thought, mate, imagine if it was more than 10% against. You do not like criticism, Mr. Crommelin, you cranky old chair. But yeah, he launched a massive spray at ISS for daring to recommend against the remuneration policies, which has made the CEO worth $25 million. And the controlling shareholder, Nick Politis, is a comfortable billionaire with his 29% now worth close to $1.5 billion. So who would have thought car retailing would be booming to the extent that it is through Eagers Automotive?
That. And they've got 14% of the Australian market. That's amazing.
Up from 10. And the biggest growth's been hybrids. So EVs have been steady at 6% the last 4 years. And I did ask about Tesla, and he said, yeah, look, Tesla's sales have crashed and Musk's political views have hurt them, and everyone's buying hybrids. And while we don't have a deal with Tesla, we've just done a new 5-year deal with BYD, and they are absolutely booming. And Chinese manufactured cars are now 16% of the Australian market, behind only Japan and Thailand. A lot of cars are made in Thailand, and the Japanese manufactured cars have gone past South Korea and Germany in the last year or two. So Chinese imports into Australia are booming. They've got the deal with BYD. And the other stat that I fell over was he said 1 in 3 cars sold globally now is into that China market. So it just demonstrates the size of the internal Chinese economy. Massive consumption of cars and massive exporter of cars, and that's a key part of their success globally, you'd argue. The China car play, including through BYD.
Okay, before we get on to the questions, here's a quick word from our sponsor.
Want to give your kids or grandkids a solid financial head start? Just $50 a week could grow into an $84,000 nest egg by the time they turn 18. Sounds good, right? But it does mean looking beyond traditional savings accounts, especially with rates falling. If you're ready to explore smarter, long-term investing strategies, InvestSmart has a free ebook that shows you how. It covers investment options, tax traps to avoid, choosing the right account structure, and even ways to get the kids involved. Ready to move beyond the piggy bank? Download your free copy today at investsmart.com.au/guides.
Okay, first question from Reese. There's been plenty of commentary that tariffs will cost Americans more at the checkout. Is this actually a sneaky way to introduce the GST, albeit only on imported goods, in order to raise federal revenue, dampen consumption of foreign products, and partially at least recalibrate America's spending on to what they really can afford? Is there a difference between GST and tariffs other than which products are taxed? You're right, absolutely right, Reese. What do you reckon, Steve?
Yeah, look, it's just a xenophobic GST. That's all it is. I mean, a GST is just like a tariff. It's a sales tax. But if you start discriminating between stuff made locally and stuff overseas, then it's a tariff. So, but it's regressive. That's the other big point about tariffs is they are very regressive.
Like all GSTs.
Yeah, exactly. So you got to be careful with how hard you go with them, because it will hurt the consumer. And the poorer, lower income people will be more hard hit by tariffs. But absolutely right. Chrissy says, I've recommended your podcast to my HSC economics students, and I love listening each week. It certainly makes for interesting discussions in the class. I'm curious to know what you really think about the investments within the Future Generation listed investment company chaired by former RBA Governor Philip Lowe, which you mentioned last week. Keep up the great work. So from an independent female investor, thank you, Chrissy. Look, Future Generation is one of, I would argue, too many listed investment companies on the ASX. There's dozens and dozens of them, but they've raised $500 million. And it was Jeff Wilson's idea. And what they do is they get 20 different fund managers to donate their services. So you feel good about buying this LIC, and then you can't see what stocks they pick because they just carve it up to the different fund managers. So I can't tell you that they've bought this many BHP or this many Commonwealth Bank, but they're well diversified with 20 different fund managers. They're performing fine, but at the end of the day, they're just one of dozens and dozens of listed investment companies. But they sell the feel-good factor of fund managers donate their fees, and we donate $5 million a year to good causes to help troubled youth, etc. and
Well, that's
the
a good
performance
thing.
is fine. And that's the
a good
that's
thing.
a good.
Don't
That's
you
a
think?
good thing.
That's all right.
Look, I shouldn't be.
You're sounding a
dismissing it.
bit. You're sounding a bit sceptical of it there, mate.
Oh well, it's a Sydney funds management feel good club exercise. You got to have the big trophy chair in the form of Gov, and they're performing just fine. And they do raise. They've given away. I think it's 43 million since they started to different good causes. So look, it's an interesting model, and it's doing well, and it's good to see the Gov's got a gig post being the Gov.
Ben says all this fuss over the $3 million on cap not being indexed. He's talking about the extra tax on superannuation balances over $3 million not being indexed is political noise. It will eventually be indexed. Sure, we'll get some bracket creep, but however, it's in the interest of the government to relax it, to index it. If it were never indexed, it would effectively make super obsolete and everyone would be screaming for an age pension, which goes against the purpose of super, and no government wants that. Oh, yeah, probably. I think you're probably right. They will eventually index it. I heard that when it was put to Jim Chalmers, someone told me that someone said, "Oh, you got to index it, Jim." He says, "No, I'll leave that to someone else."
Well, they don't index income tax brackets, so
they should. That's right.
They should. But where do you see the debate going with the $3 million? Like I was amused. You've got two WiseTech directors, including I'll give you an example. Michael Gregg, who's just one of the WiseTech directors, has $550 million worth of WiseTech shares sitting in his super fund with his wife. So it all starts on July 1. So if the shares go up 20%, so if he makes, for instance, $100 million on paper over the next 12 months, if he keeps in that superstructure, he'll have to pay the government $30 million because he's had a paper gain of $100 million on that. And I think for me, that is a fundamental problem because it doesn't apply to all the other rich listers out there who might be using company structures or trust structures or foundations, the Chemist Warehouse billionaires. Twiggy Forrest is using foundations. So it's going to cause a mass exodus from super funds in terms of people holding their investments in public companies that are doing well. Maybe you can argue that's a good thing because it is dodging tax and super wasn't designed to hold billions of dollars worth of shares. And so, okay, but for mine, this is going to get people out of big rich people will get out of super because of this policy.
Well, I don't think that's a problem at all. I mean, superannuation is meant to enable ordinary people, middle class people, to save for their retirement and to live on their retirement savings instead of the age pension. And it's being used by a lot of people, including that bloke from WiseTech, to simply dodge tax and bugger it. I don't think they should. Take his bloody $500 million worth of WiseTech shares out of a super fund and just own them and then pay capital gains tax.
And you don't have a problem with the fact that super is, it's Hotel California. Once you're in, you can't get out until you're 60 or 65. Like you really are trapped in. So you can't just, roll out. Once you exit, then that'll be a triggering event. Look, I agree with you. But I just have a problem with setting the precedent of taxing unrealised gains because it doesn't happen in other investment vehicles. I think it's bad tax policy from that point of view. And it also it raises doubt about the confidence people have in the super system because the whole biggest risk with super is the government might one day change the rules. And this, frankly, is probably the biggest tax grab ever done on the super system. And they think they can raise $2-3 billion a year by hitting the rich, but it will undermine confidence overall. And it's that general principle of moving the goalposts. You tell everyone this is the tax rate, in you go, and then, hang on, we'll take 30% and we'll do it in an unrealised manner, which we don't do in any other form of tax, which is setting a scary precedent, don't you reckon?
Yeah, but I do think there's a bigger picture here, which is that Australia probably needs some sort of wealth tax or inheritance tax because we are not raising enough money from tax. So they have to do something. They have to do something, whether it's this or something else. I don't know. I mean, I'd rather they do this than increase the GST to 20% or increase income taxes again. I don't think that's a good idea. So, I don't know.
And this is their only tax revenue grab idea of the first term. They didn't come up with any other reform. This is it. And it got surprisingly little coverage during the election, and it's getting surprisingly large amount of coverage after the election because it's one of the few controversial things that's going to go to the parliament that is actually going to raise a material amount of money. So the press is absolutely flogging the government, but there's no leverage because they've just got to do a deal with the Greens and through it goes. But you even got Gina Reinhart getting quoted in the Fin Review today having a whinge. So the rich and the powerful are going to fight this pretty hard, I think, Alan.
Surprised me.
And Labor doesn't give a stuff, so it'll go through and you'll see a whole bunch of people exit super. But, maybe that's a good thing and it'll get back to being what it's for, which is for savings vehicle for ordinary Australians.
Yes.
Michael says, last week Alan referred to the 4 convincing reasons why house prices in Australia surged after the year 2000. Can I suggest you forgot the 5th? Australia was put on the global map as a safe, friendly and wonderful place thanks to the September 2000 Sydney Olympics. I agree with your other 4 points, but this is a 5th contribution which ties in with soaring migration demand and international student arrivals. Look, that's probably right, Michael. It was a magnificent marketing thing for Australia. Who would have thought that 25 years later, Sydney would be the world's most expensive residential property market once Hong Kong drops down a bit?
Maybe, to be honest, I had not thought of that. I think he's probably right.
And the other point is that our terms of trade had basically weakened consistently for 100 years up until the year 2000. It was just more and more. It was just going down and down and down. Iron ore prices were, $15 a tonne, $20 a tonne. And then since then, we've just had this magnificent improvement in the terms of trade. It's gone in our favour and it has generated enormous wealth for Australia. And that wealth has floated all boats, including residential property market prices. So, we've just ridden this mining boom. The AFR Rich List is out tomorrow. Who would have thought that James Packer would be struggling to be in the top 20 and there'd be all these iron ore miners worth collectively over $100 billion? I mean, this has been a massive change to our economy and has driven up all asset prices from a wealth effect point of view.
Kate says, the Money Café is very testosterone-filled. Seriously, if you listen from a woman's perspective, maybe an Alan Graph on how many women compared to men listen to which commentators. I think Mamma Mia wins hands down on gender graphics. Well, I can assure you, Kate, that at the age of 73, my testosterone is draining away, but I don't know about Stephen and James.
Goodness me, we're not going there, surely.
No. Okay, but Kate's question is not this tax of the 3 million plus 3 million plus going to help the underpaid people who have not got the 3 million plus in super, e.g. women? Why do you and others in the media not support this fair wealth tax? Well, we're not supporting it. I mean, Stephen thinks that the unrealised gain problem is an issue. I'm not sure about that, but anyway. So I think we're basically on board with the tax, aren't we, Stephen?
Well, yeah, but I mean, Kate's point's interesting. 80,000 people are affected. She's probably right that less than 10,000 of them will be women. So one of the great inequalities in Australia, Gina Reinhart aside, is the gender inequity in who owns Australia, who owns the wealth. It is still, 90%. So a wealth tax that is reinvested into services is definitely a positive gender equity move, given that men dominate the ownership of the wealth. So from a gender equity point of view, Kate is right. This is a good tax. It will raise money from rich men and can be respent on helping everyone. And that's an interesting point, Kate. Now, Bill says, last week you and Stephen discussed the difference in royalties on miners in Queensland and WA, and somehow the international mining organisations have pulled the wool over most people's eyes and they've conflated royalties and taxes. Royalties need to be considered as what they really are, a cost of goods sold. Miners are purchasing the dug-up stuff from the owners, the government. It is a cost, not a tax. Well, I disagree,
I reckon
Bill.
He's splitting hairs there, isn't he?
Well, it's both. It's a cost because, you do get to tax deduct it. So the Queensland government, both Labor and LNP, have introduced the world's highest coal royalties, peaking at 40% above $300 a tonne. And that is a cost of doing business for them, but it is also a tax. But they can tax deduct that cost and pay less tax to the federal government because they're paying, $10 billion a year to the Queensland government.
There you go. That's the difference. I mean, and look, it's true that the royalty means that the miners are buying the stuff from the people of the country, and that's fair enough.
But it's almost like a sales tax, isn't it? Because it's based on the selling price. In WA, the iron ore royalty is only 7%. It's ridiculously low. That's why you got so many rich listers from iron ore. And it's a sales tax based on the sales price. It's not a profit-based tax. At least in Queensland, with their sliding scales, the higher the price, the higher the percentage tax. That does have a profit element to it. But I don't think, Bill, we can call it a cost.
What do you think the royalty in WA should be? The iron ore royalty should be?
The Queensland model is right, is that it should be a rising scale. So when the iron ore price is above $100 a tonne, bearing in mind the average cost is $20 a tonne. I mean, this thing has an 80% profit margin. The WA government should be having a 40% royalty on everything that's sold above $100 a tonne. And Broome should be like Dubai, instead of having literally trillions of dollars of wealth taken from the Pilbara going to foreign companies, BHP, Gina, a lot to Canberra because they get 30% through the company tax. It should be a rising scale like in Queensland, and WA would be net worth $100 billion if they had this, rather than having a public bonds on issue and government debt of still $30 to $40 billion. You don't see the Saudis with a $30 to $40 billion debt, do you? They've monetised their oil. Like the Norwegians have got, $1.8 trillion because they properly taxed and owned the oil. In WA, it's the world's worst example of not monetising your government-owned resources dowry and allowing it to be milked by everybody else except for the actual people who own it, which is the taxpayers of Western Australia. Now, anonymous divorcee writes, last week you had Shane write in about the generous desktop valuation by the Commonwealth Bank. Well, I was a fortunate recipient of this too, with the Commonwealth Bank saving my butt with a very generous valuation on my house. I was in the midst of a messy divorce and had to refinance the house to keep it as part of the settlement. My ex-wife got the investment property, so don't feel too bad for her. The very generous CBA valuation of the house for the refinance means I was able to refinance without getting mortgage insurance at close to 100% valuation. Yes, the interest rate was higher than others, but when you add the cost of mortgage insurance to the broker, this worked better for me in the end. And this practice is well known with the CBA. My mortgage broker knew all about it.
That's interesting.
So there you go, Alan. That's how the Commonwealth Bank has a $583 billion mortgage book, 25% market share. They keep on upping the valuation, upping the interest rate, because that's how their market cap's $291 billion. And apparently this is commonly known. The Commonwealth Bank will lend you more at a higher price. There you go.
I'm with NAB, and the last time they valued my house, they didn't do it. They got an independent valuer to do it, and the valuer is very conservative. I think that might be the difference. Maybe Commonwealth Bank does it themselves rather than using an independent valuer.
It's funny. I knew a bloke who lived near Mick Gatto, and he was told that the bank had put his valuation down by 10% based on his neighbour. So I thought that was an unusual approach for the bank to take. But
crikey.
Anyway, Miles says, in recent public comments, Michelle Bullock appeared to wash her hands of the issue of falling interest rates driving worsening housing affordability. However, I was left wondering if declining rates of home ownership could create future problems for the RBA, where the economy does not react either as much or as quickly to rate changes. Do you think the RBA should be concerned with this, Alan?
Well, I was interesting. I saw a piece the other day, I think it was in the Fin Review as well, that the Reserve Bank is worried about rising house prices, and that might stop their hand in further cutting interest rates. So I don't know. I did go back over the last 10 rate cut cycles and look at the change in house prices in the 2 years following the start of the rate cut cycle, and the average increase in house prices in those 2 years is 30%. So
wow,
it is the case that when rates are cut, house prices go up because housing becomes more affordable.
So if we get down to the neutral rate of 3.1 by the end of the year, that's potentially going to send Sydney prices well past Hong Kong to be the least affordable in the world. I mean, if we get a 10 to 20% increase on what we've already got, heaven forbid, that's $1 trillion of extra value. I mean, it's great for the current owners.
To the point,
great for the banks that lend against it, but try to enter that market.
Well, the problem is that house prices go up quite a lot, on average 30% when rates are cut, but they don't come down by the same amount when interest rates go up, because people don't tend to sell their house. When they're squeezed by higher interest rates, they don't sell their house. What they do is they cut elsewhere. So it doesn't result in house prices falling as a result of lots of houses coming back on the market and people taking lower prices. And so what happens is that with the interest rate cycles of rises and falls in interest rates, house prices tend to ratchet up. They go up, 30% when prices are cut, and then they come down by 10 to 15% when rates go up. So
but we've never had a 10%, more than 10% cut since Keating's recession we had to have. So
that's right. I mean, but house prices fell by 9% in the first part of the latest increase in interest rates from after May 2022. The RBA increased rates 13 times. In the first kind of 9 months of that, house prices did fall 9%, but then they just turned around and rose another 15%, even while house prices kept rising. So, but look, so yeah, I mean, the cycle of interest rates might sort of bring them back to neutral, but it doesn't result in house prices staying the same. They get ratcheted up.
Last question.
Perhaps time for one more.
Your choice.
Oh, my choice. Right, okay. Sam says, thanks for the excellent discussion on the future of work and taxation in the context of AI. I'm wondering whether there are any opportunities in the transition to Australia becoming a global renewable superpower to boost government revenues in a sustainable way. We missed the boat on generating a lasting wealth mechanism from the mining boom. Could we be looking at the start of the next opportunity? Well, I mean, the superpower thing is Ross Garnaut and Ross Garnaut's main point. He wrote a book about it, saying Australia's going to become a superpower. I just think, I don't know. I can't. I'm not seeing that yet. I don't think the government's doing anywhere near enough for Australia to become a superpower in renewables. The place that is becoming a superpower is China, not Australia. We need to do far more than we're doing.
Our only superpower is in resources, where we are the top couple of nations in the world with what we've got. And I'd also argue, if people say we've squandered the mining boom, I would argue that something like the NDIS which is a massive new government redistribution social program, almost costing as much as Medicare on the projections, that has been funded, in part by the mining boom. Because the government's had a surge of revenues and they've put it into, rather than a Norwegian-style sovereign fund, they've put it into new service programs, such as the biggest one being the NDIS. And many people would argue that's a good use of the mining boom as opposed to stashing it all away for a rainy day.
Fair enough. Okay, well, thanks for all those excellent questions, and great to talk to you again, Stephen. Thanks for listening to today's episode of Money Café. I'll be back next week with James Thompson. Send in your question to themoneycafe@eurekareport.com.au. Till then, I'm Alan Kohler, founder of Eureka Report and finance presenter and columnist for the ABC.
And I'm Stephen Mayne, and we'll see you in a fortnight.